Hello and welcome to the weekly wrap-up. I'm Sophia Aribo. Joining me for a look back at the key events of the last 7 days is Jan Randolph, Director of Sovereign Risk at IHS Global Insight. This week's release of French PMI data for April showed the rate of growth has slowed down. France is the Eurozone's second biggest economy, and when PMI figures were unexpectedly high in March, some analysts took it as a sign of recovery throughout the Eurozone. Was the earlier analysis about a Eurozone recovery too optimistic?
Well, I think the French PMI indices over the last few months have been a bit more erratic, but the trend is showing an industry that's moving from recession to stabilization at best. There's been a little bit more regression than elsewhere, but overall, when we look at the Eurozone, the key PMI has been Germany, the largest economy, leading the way. And the new news really is the strength of the recovery of PMIs in the periphery. Both of those are higher than the French numbers. But I think most important is Germany being the largest economy, the fact that it is more globalized economy in Europe and the rest of the world than France. And so when Germany grows, it provides a good lift for all the countries around it, where all its supply chains to its industry are put down. I think the PMI numbers are short-term indicators to economic activity, and they're widely watched, understandably. But what's really important is GDP at the end of the day, and we are seeing overall in the Eurozone an improvement and spreading of the recovery led by Germany, moving into the periphery. It's true that France and Italy are laggards, but overall we are seeing 0.4% growth in the first quarter, improving to 0.5% in Q2. And I think the recent PMI from all countries showed greater traction in the recovery, and that eventually France and Italy will follow suit.
Wednesday saw Portugal hold its first regular bond auction in 3 years. What are the indications for the government being able to announce Portugal's exit from its €78 billion bailout?
Well, the recent launch of bonds in the open market is good news. It was 3.5 times oversubscribed. It shows that there's a strong market sentiment for Euro peripheral asset, including bonds. I think that paves the way for a clean exit from the bailout next month without the support of a credit line from the ECB. I think overall it does demonstrate not simply the sentiment in the market, which has turned around in favor of the euro since the start of the year, but it also shows that on the ground, Portugal has managed the crisis relatively well, meeting all its targets, and on occasion, frequently doing better than the targets set for it on the fiscal. But underlying that, a lot of these peripheral nations, particularly Portugal and Ireland, have shown that they are able to re-engineer their economy. In other words, they've boosted the external side with a current account surplus, showing that the economy is essentially self-financing and essentially has less need for foreign savings through the bond markets.
And lastly, the US Court of Appeals began hearing a case that could make it harder for the government to prosecute insider trading. Has the US government got tougher on insider trading since the financial crisis?
Yeah, it's a very interesting topic. It essentially boils down to conflicts of interest between investors and also the relationship between investors and their clients. I think the current legislation that the US government would feel is adequate. The real issue is the implementation of the legislation when it comes to searching out where there has been conflict of interest, as in the case, for example, rating agencies and the rating of collateralized debt securities, which was the center of the crisis of 2007. It really is a question of there is adequate legislation. The issue is identifying where the problems arise and whether investors and culprits could be brought to court, basically, under the current legislation.
Thanks for joining us, Jan. That's all from me right now. Thanks for watching.